when I started this business in the late 90s, it was very much A shares, active management. It's kind of the name of the game, right? And then as I saw that transition into more of a, well, what's the value in that? Maybe we have a more passive approach, and maybe having, kind of a move towards passive than a move towards ETFs, and you've seen that in wealth management. But as we get more into non-traditional stock and bond investing, and maybe saying, okay, well, 80-20 works, but we could, build a portfolio with lower pairwise correlation if we throw, a commodities fund in, or have some REITs in, or, things like that. To that end, you do see a little more active management again, right? Like on that end, and it feels a little cyclical. So I was wondering, to some extent, passive v active, where do you land on the commodities world? So I don't imagine you just go buy a bunch of corn and cross your fingers, right? Like that's not going to work there.
Yeah, no, definitely do not cross our fingers ever. And I think that's what I enjoy about working at Dimensional, since we are taking, that more systematic approach, that I've got the evidence in our research. And, my job is purely to implement that research.
Yes.
You really speak, probably kind of two questions in there. The first is more institutional type involvement in the markets, here specifically with commodities. It's something I often get questions of, or is this market too saturated with institutional investors to now start to damping out some of the premiums that maybe we've seen in the past? And we really haven't seen evidence of that. It's a very vibrant market with some very big commodity players.
Sure.
They're just getting bigger in the market, hedging their production, supply, very much downstream to that, all the way from the field to the tabletop on the agricultural side. On the dimensional side, we focus a lot on the shape of those commodity curves, looking at those on a curve by curve basis, looking if there's advantages in a few different places. Probably list three of them. We'll look and see if there's opportunities to maybe roll our exposure outside of a normal roll period, so to avoid the market congestion that we sometimes see with index followers. And so we're somewhat benefited by having so many index players in there that they continue to congest the market. We avoid that congestion. We'll also look across curves. We see very much valuable information in the shape of a commodity curve. I get to use some of those fun finance terms that maybe you spent a class on in undergrad, contango and backwardation.
Oh, contango's one of my favorites. Contango's one of my favorites.
Yes. So I get to say that all the time in my job. And so we will look at the shape of the curves and allow our portfolio some ability to dynamically adjust its exposure across those curves in order to really accentuate some of the opportunities there. And then you can even see, if you're looking, in our case, with 24 commodities, there is some ability to maybe tilt your portfolio more towards those backwardated commodities, away from the contango type commodities. And so that's kind of really, if you were looking at our strategy today, that's what we're looking to do, is provide that enhancement through a more systematic approach that doesn't necessarily rely on me hoping that I know how El Nino is going to turn out.
Right, and certainly not. Yeah. So the research focused, research driven, right? That's like the philosophy, and I think that's just fantastic. Being a PhD, yes, I love that philosophy of investing.